लाइव हाई। तो अभी अपन कर रहे हैं 0 to 1। पूरा रीड कर रहे हैं अपन इन टू एंड। पहला चैप्टर पढ़ लिया अपन ने इसका, द चैलेंज ऑफ द फ्यूचर। सो आर लर्निंग्स फ्रॉम द फर्स्ट चैप्टर। अपने आप को पूछो, व्हाट इंपॉर्टेंट ट्रुथ डू वेरी फ्यू पीपल अग्री विथ यू ऑन। इसके सारे फालतू फालतू जवाब देंगे सब लोग। अ गुड आंसर would be as close as we can come to looking into the future। और फ्यूचर क्या है? इधर ये फ्यूचर टेंस की बात नहीं कर रहे हैं। फ्यूचर इज बेसिकली व्हेन कंडीशंस चेंज फ्रॉम द प्रेजेंट। बेसिकली इंटरनेट वाज द फ्यूचर व्हेन इंटरनेट वाज नॉट देयर। द व्हील वाज द फ्यूचर व्हेन व्हील वाज नॉट देयर। सो ये उस सेंस में फ्यूचर की बात हो रही है। नाउ प्रोग्रेस कैन बी मेड इन अ वर्टिकल एंड अ हॉरिजॉन्टल मैनर। Vertical progress is 0 to 1 when we create something new, innovation, technology. And technology is not confined to like computers. Technology is doing anything in a new and a better way. Or horizontal progress is globalization. Either author points out that vertical progress or technology is done very well at Silicon Valley, and अपना horizontal progress, that is globalization, is done very well by China। ठीक है। The author points out that our surroundings are strangely old। I have trouble linking with that because I live in Bangalore, so everything is very fast paced. I see new things every day. There are so many things in Bangalore that are here from the last 5 years only, from the last 10 years only, from last year only. And very new things like EVs. EVs are something that are very relatively new. Like it's been like maybe 3 4 years that EVs have been normalized. उसके पहले I don't think there were a lot of EVs। I was in school or college, so I don't have that much idea as well, but I don't think it was there। और हाँ, new technology is done very well by startups, particularly because in big organizations. The author points out that to climb the ladder, a better strategy is to show that you're doing a lot of work than to actually do the work, which is not the case in startups because startups are small teams, everyone knows who is doing what. And in startups, people are generally motivated to do something bigger, to create something new, and they have the same energy, same goal, same ambition. In bigger organizations, the goal is more personal for a lower level employee, I think, than the company's goal. And I think the author also wants to say this. Author is the right word, right? I should be saying okay, 0 to 1. Yeah, author Peter Thiel. So we'll refer to him as Peter, not author. ठीक है भाई। And if you are somewhere where in a big organization where it is a better strategy to show a lot of work than to actually do it, you should immediately quit, as Peter suggests। And startup, he defines startups as the largest group of people you can convince of a plan to build a different future, basically creating something new that is not there। Hello, I am audible, right? How do I check this? Just a second, I'll check it. How do I get the link though? The link to my YouTube live stream. On PC. भाई एक सेकंड ये क्या हो रहा है? है हाँ, it's audible. Okay, we're audible, guys. Okay, फिर ठीक है. The second chapter is Party Like It's 1999. So, our question: What what unpopular, nahi, what truth do you believe in that other people disagree with? Something on those lines. What important truth do very few people agree with you on? Okay, so it's difficult to answer directly. It may be easier to start with a preliminary. What does everybody agree on? Madness is rare in individuals, but in groups, parties, nations, and ages, it is the rule. Nietzsche wrote, before he went mad. Is Hitler referred to as Nietzsche? Oh, sorry. He was a philosopher. Friedrich Wilhelm Nietzsche was a German philosopher. He began his career as a classical philologist, turning to philosophy early in his academic year in 1869, age 24, to hold the chair of. Okay, he was a philosopher who went mad. ठीक है, अपने हो गया. If you can identify a delusional popular belief, you can find what lies hidden behind it. The contrarian truth. Consider an elementary proposition. Companies exist to make money, not to lose it. This should be obvious to any thinking person, but it wasn't so obvious to many people in the late 1990s, when no loss was too big to be described as an investment in an even bigger, brighter future. The conventional wisdom of the new economy accepted page views as a more authoritative, forward looking financial metric than something as pedestrian as profit. Conventional beliefs only ever come to appear arbitrary and wrong in retrospect. Whenever one collapses, we call the old belief a bubble. But the distortions caused by bubbles don't disappear when they pop. The internet craze of the 90s was the biggest bubble since the crash of 1929, and the lessons learned afterward defined and distort almost all thinking about technology today. The first step to thinking clearly is to question what we think we know about the past. Yeah. So the 1990s dot-com bubble was when people were a lot more focused on views and spending a lot of money, even after losing it, than they were on making profits. So it was a bad strategy. And to a layman, it was very obvious that, of course, you should not be losing money. Companies are meant to make profit, not to make losses. But uh, in the masses, in the dot-com bubble, everyone believed that losing a lot of money is just an investment into a bigger, brighter future, and views are all that matter. Not exactly views, so clicks, visits, users are all that matter. But eventually, this bubble burst, and the easy money that a lot of startups were getting was eventually over. Yeah. A quick history of the 90s. The 1990s have a good image. We tend to remember them as a prosperous, optimistic decade that happened to end with the internet boom and bust. But many of those years were not as cheerful as our nostalgia holds. We have long since forgotten the global context for the 18 months of dot-com mania at decade's end. The 90s started with a burst of euphoria when the Berlin Wall came down in November 89. It was short lived. By mid 1990, the United States was in recession. Technically, the downturn ended in March 91, but recovery was slow and unemployment continued to rise until July 92. Manufacturing never fully rebounded. The shift to a service economy was protracted and painful. 1992 through the end of 1994 was a time of general malice. Malice. Okay. Images of dead American soldiers in Mogadishu looked on cable news. Anxiety about globalization and US competitiveness intensified as jobs flowed to Mexico. This pessimistic undercurrent drove then President Bush 41 out of office and won Ross Perot nearly 20% of the popular vote in 92, the best showing for a third party candidate since Theodore Roosevelt in 1912. And whatever the cultural fascination with Nirvana, grunge, and heroin reflected, it wasn't hope or confidence. Silicon Valley felt sluggish too. Japan seemed to be winning the semiconductor war. The internet had yet to take off, partly because its commercial use was restricted until late 1992, and partly due to the lack of user-friendly web browsers. Okay, so okay, 92 there was a lack of user-friendly web browsers. Okay, It's telling that when I arrived at Stanford in 1985, economics, not computer science, was the most popular major. To most people on campus, the sector seemed idiosyncratic or even provincial. What the fuck? Like, idio. Okay, it seems idiotic or something. Idiosyncratic. Tell me the meaning. Google also does not know. Cambridge does. Having strange or unusual habits, ways of behaving, or features. Strange or unusual habits, basically. Provincial, basically. Provincial meaning. Connected with one of the large areas that some countries are divided into. Connected with the power. Do not include its most important city. Acha, not wanting to consider new or different ideas or fashions. Okay. The internet changed all this, of course. The Mosaic browser was officially released in November 1993, giving regular people a way to get online. Mosaic became Netscape, which released its Navigator browser in late 1994. Navigator's adoption grew so quickly from about 20% of the browser market in January 1995 to almost 80% less than 12 months later that Netscape was able to IPO in August 95 even though it wasn't yet profitable. Within 5 months, Netscape's stock had shot up okay. Other tech companies were booming too. Yahoo went public. ठीक है. Amazon followed suit in May 97. Huh? When did Amazon go public? What was the starting business of Amazon? Amazon started as an online bookseller. Okay. Okay. Or Mosaic. What was Mosaic? Mosaic browser. Mosaic was the first widely popular graphical web browser released in 1993 by NCSA, known for integrating images with text on the same page, and its user-friendly interface, which significantly boosted the World Wide Web's popularity and paved the way for browsers like Netscape Navigator. देखते हैं, let's see. How does the Mosaic browser look? Let's check out a video. Okay. Let's skip Navigator के images will see. यार चलो okay. Basically, these were the two founding browsers, Mosaic and Netscape Navigator. आगे बढ़ते हैं, ये बंद करो. Okay. Amazon was an online bookseller in the starting. 95 it was founded in, or 97 it went public at $438 million. Wow. By spring of 98, each company's stock had more than quadrupled. Skeptics questioned earnings and revenue multiples higher than those for any non internet company. It was easy to conclude that the market had gone crazy. This conclusion was understandable but misplaced. In December 96, more than 3 years before the bubble actually burst, Fed Chairman Alan Greenspan warned that irrational exuberance might have unduly escalated asset values. ठीक है. By the spring of 98, it was easy to conclude that the market had gone crazy. The conclusion was understandable but misplaced. In December 96, more than 3 years before the bubble actually burst, Fed Chairman Alan Greenspan warned that irrational exuberance might have unduly escalated asset values. You will write this down because I don't understand it. फेड चेयरमैन ने बोला था irrational exuberance might have unduly escalated asset values. Fuck, I still don't understand it. Okay, we'll have a look. Tech investors were exuberant. First, we'll check out what exuberant means. Okay, full of excitement. Tech investors were exuberant, but it's not clear that they were so irrational. Okay, it is too easy to forget that things weren't going very well in the rest of the world at the time. The East Asian financial crisis hit in July 97. Crony capitalism and massive foreign debt brought the Thai, Indonesian, and South Korean economies to their knees. The ruble crisis followed in August 98 when Russia, hamstrung by chronic fiscal deficits, devalued its currency and defaulted on its debt. We'll have to check all of this. I don't understand it. Irrational. Okay, there is a book, Irrational Exuberance, might have unduly escalated asset values. This irrational exuberance describes investor enthusiasm pushing asset prices far above their fundamental value, famously warned about by Alan Greenspan in 1996 during the dot-com bubble, highlighting how market euphoria, not just economic growth, can inflate values, creating bubbles prone to sharp, sudden collapses as seen in tech booms or speculative trading. This phenomena involves buying assets at any price due to hype, ignoring risks, and expecting continuous gains, a pattern seen in history from tulip mania to the 2000 stakes. Okay, we'll ask ChatGPT once as well. Investor enthusiasm became so excessive and emotional that it pushed asset prices higher than the real underlying value. Okay, so basically that. Okay, bubbles may. I think this is what happens every time. Hmm. East Asian financial crisis 97. इसको पहले बोल देते हैं. Give me, keep giving me short. चल रहा है. Summaries of all the events have been mentioned. Okay, perfect. East Asian financial crisis. I'll share the screen. A sudden collapse of currencies and stock markets. They are triggered by financial instability. I think. Okay, excessive foreign borrowing. East Asian. The ruble crisis. Russia defaulted on debt and devalued the ruble after financial mismanagement. Explain a bit more. Severe financial collapse after running large budget deficits and relying heavily on short-term foreign borrowing. When oil prices fell and investor confidence dropped, the government defaulted on its debt and sharply devalued the ruble. This triggered banking failures, inflation, and a brief shock of global financial markets. Okay, devalued. Okay, inflate. Yeah. What does sharply devaluing the ruble mean? Sharply devaluing. Okay. American investors grew nervous about a nation with 10,000 nukes and no money. The Dow Jones Industrial Average plunged more than 10% in a matter of days. People were right to worry. The rebel crisis set off a chain reaction that brought down long term capital management. The highly leveraged US hedge fund LDCM managed to lose $4.6 billion in the latter half of 98 and still had over $100 billion in liabilities when the Fed intervened with a massive bailout and slashed interest rates in order to prevent systematic disaster. Europe wasn't doing that much better. The euro launched in January 1999 to great skepticism and apathy. It rose to $1.19 on its first day of trading but sank to $0.83 within 2 years. In mid 2000, G7 central bankers had to prop it up with a multi billion-dollar intervention. So, the backdrop for the short lived dot-com mania that started in September 98 was a world in which nothing else seemed to be working. The old economy couldn't handle the challenges of globalization, something needed to work and work in a big way. If the future was going to be better at all, by indirect proof, the new economy of the internet was the only way forward. Mania, Sep 98 to March 2000. Dot-com mania was intense but short, 18 months of insanity from September 98 to March 2000. It was a Silicon Valley gold rush. There was money everywhere and no shortage of of exuberant, often sketchy people to chase it. Every week, dozens of new starters competed to throw the most lavish launch party. Landing parties were much more rare. Paper millionaires would rack up $1,000 dinner bills and try to pay with shares of their startup stock. Sometimes it even worked. Legions of people decamped from their well paying jobs to found or join startups. One 40 something grad student that I knew was running six different companies in 1999. Usually, it's considered weird to be a 40-year-old graduate student. Usually, it's considered insane to start a half dozen companies at once. But in the late 90s, people could believe that was a winning combination. Everybody should everybody should have known that the mania was unsustainable. The most successful companies seemed to embrace a sort of anti-business model where they lost money as they grew, but it's hard to blame people for dancing when the music was playing. Irrationality was rational given that appending .com to your name could double your value overnight. Of course. You just put a .com and your value doubles overnight. What's happening with .ai is very similar to this, although now maybe the investors are much more smart and careful. PayPal mania. When I was running PayPal in late 1999, I was scared out of my wits, not because I didn't believe in our company, but because it seemed like everyone else in the valley was ready to believe anything at all. Everywhere I looked, people were starting and flipping companies with alarming casualness. One acquaintance told me how he had planned an IPO from his living room before he'd even incorporated his company, and he didn't think that was weird. In this kind of environment, acting sanely began to seem eccentric. At least PayPal had a suitably grand mission, the kind that post bubble skeptics would later describe as grandiose. We wanted to create a new internet currency to replace the US dollar. Our first product let people beam money from one Palm Pilot to another. However, nobody had any use for that product except the journalists who voted it one of the 10 worst business ideas of 99. Palm Pilots were still too exotic then, but email was already commonplace. So we decided to create a way to send and receive payments over email. By the fall of 99, our email payment product worked well. Anyone could log into our website and easily transfer money, but we didn't have enough customers. Growth was slow and expenses mounted. For PayPal to work, we needed to attract a critical mass of at least 1 million users. Advertising was too ineffective to justify the cost. Prospective deals with big banks kept falling through, so we decided to pay people to sign up. We gave new customers $10 for joining, and we gave them $10 more every time they referred a friend. This got us hundreds of thousands of new customers and an exponential growth rate. Of course, this customer acquisition strategy was unsustainable on its own. When you pay people to be your customers, exponential growth means an exponentially growing cost structure. Crazy costs were typical at that time in the valley, but we thought our huge costs were sane. Given a large user base, PayPal had a clear path to profitability by taking a small fee on consumers' transactions. We knew we'd need more funding to reach the goal. We also knew that the boom was going to end. Since we didn't expect investors' faith in our mission to survive the coming crash, we moved fast to raise funds while we could. On Feb 16, 2000, the Wall Street Journal ran a story lauding our viral growth and suggesting that PayPal was worth $500 million. When we raised $100 million the next month, our lead investor took the journal's back of the envelope valuation as authoritative. Other investors were in even more of a hurry. A South Korean firm wired us $5 million without first negotiating a deal or signing any documents. When I tried to return the money, they wouldn't tell me where to send it. The March 2000 financing round bought us the time we needed to make a PayPal success. Just as we closed the deal, the bubble popped. Lessons learned, because they say 2000 party over. Oops, out of time. So tonight I'm gonna party like it's 1999. Prince. Okay. The Nasdaq reached 5048 as it at its peak in the middle of March 2000 and then crashed to 3321 in the middle of April. By the time it bottomed out at 1114, in October 2, the country had long since interpreted the market's collapse as a kind of divine judgment against the technological optimism of the 90s. Everyone learned to treat the future as fundamentally indefinite and to dismiss as an extremist anyone with plans big enough to be measured in years instead of quarters. Globalization replaced technology as the hope for the future. Since the 90s, migration from bricks to clicks didn't work as hoped. Investors went back to bricks and BRICS. The result was another bubble. This time in real estate, the entrepreneurs who stuck with Silicon Valley learned four big lessons from the dot-com crash that still guide business thinking today. Fuck, I need coffee. Zepto. Something to eat as well, yes. Next, let's check on Zomato. Oof. Sasos. Snack. Chayos. Their filter coffee is 200 rupees. Too much. Lessons learned. The Nasdaq reached 5048 at its peak in the middle of March 2000 and then crashed to 3321 in the middle of April. By the time it bottomed out at 111, the country had long since interpreted the market's collapse as a kind of divine judgment against the technological optimism of the 90s, was relabeled as an era of crazed greed and declared to be definitely over. Everyone learned to treat the future as fundamentally indefinite and to dismiss as an extremist anyone with plans big enough to be measured in years instead of quarters. Globalization replaced technology as the hope for the future. Since the 90s, migration from bricks to clicks didn't work as hoped. Investors went back to bricks housing and bricks globalization. The result was another bubble, this time in real estate. The entrepreneurs who stuck with Silicon Valley learned four big lessons from the dot-com crash that still guide business thinking today. Make incremental advances, stay lean and flexible, improve on the competition, focus on product, not sales. Okay, so something we can take out of this. Let's go. Four lessons after dot com crash. You ordered a desi chai with bun maska. Make incremental advances. Grand visions inflated the bubble, so they should not be indulged. Anyone who claims to be able to do something great is suspect, and anyone who wants to change the world should be more humble. Small, incremental steps are the only safe path forward. Okay, make incremental advances. You cannot change the world at once without implementation. You have to implement slowly. Take one step at a time. Stay lean and flexible. All companies must be lean, which is code for unplanned. You should not know what your business will do. Planning is arrogant and inflexible. Instead, you should try things out, iterate, and treat entrepreneurship as agnostic experimentation. By lean, they mean unplanned. Improve on the competition. Don't try to create a new market prematurely. The only way to know you have a real business is to start with an already existing customer. So you should build your company by improving on recognizable products already offered by successful competitors. But if we improve on the competition, would it be 0 to 1? Is it improving on the competition 1 to 100 again? 1 to n. Focus on product, not sales. Right. If your product requires advertising or salespeople to sell it, it's not good enough. Technology is primarily about product development, not distribution. Bubble era advertising was obviously wasteful. So the only sustainable growth is viral growth. Viral growth. These lessons have become dogma in the startup world. Those who would ignore them are presumed to invite the justified doom visited upon technology in the great crash of 2000. And yet, the opposite principles are probably more correct. It is better to risk boldness than triviality. A bad plan is better than no plan. Competitive markets destroy profits. Sales matters just as much as product. Okay. Profits. So all these 4 points were just completely wrong. It's true that there was a bubble in technology. The late 90s was a time of hubris. People believed in going from 0 to 1. Too few startups were actually getting there, and many never went beyond talking about it. But people understood that we had no choice but to find ways to do more with less. The market high of March 2000 was obviously a peak of insanity, less obvious but more important. It was also a peak of clarity. People looked far into the future, saw how much valuable new technology we would need to get there safely, and judged themselves capable of creating it. We still need new technology, and we may even need some 1999 style hubris and exuberance to get it. To build the next generation of companies, We must abandon the dogmas created after the crash. That doesn't mean the opposite ideas are automatically true. You can't escape the madness of crowds by dogmatically rejecting them. Instead, ask yourself how much of what you know about business is shaped by mistaken reactions to past mistakes. Mistaken reactions to past mistakes. Fall is not to oppose the crowd, but to think for yourself. Were believed by the masses in the tech world. Think for yourself. Don't just oppose the crowds. What is the question that we have to think upon? The question is how much of what you know about business is shaped by mistaken reactions to past mistakes? I don't understand this question. How much of what you know about business is mistaken reaction to past mistakes? like evolutionary learning. Strategies emerge, fail, and get corrected to become best practices until condition. How much of what you know about business is mistaken reactions to past mistakes? Why is there the word mistaken? Am I reading it wrong? So basically, business learning is reactive and it is not definitive. So you have to think for yourself. You cannot follow any standard practices. You have to try, fail, and repeat. sufficient for yourself. Okay, third chapter. All happy companies are different. Wow. The business version of our contrarian question is, what is contrarian? We'll just confirm. On the contrary, wala contrary hai, I suppose. A person who opposes or rejects popular opinion or current practice. ठीक है. Okay, so the business version of our contrarian question is, what valuable company is nobody building? So the actual contrarian question is, what important truth do you believe in that nobody else believes in? That very few people believe in. And because you believe in that truth, you can build a company on that truth. What important truth do very few people agree with you on? What valuable company is nobody building? Nice. The question is harder than it looks. Because your company could create a lot of value without being very valuable itself, creating value is not enough. You also need to capture some of the value you create. This means that even very big businesses can be bad businesses. For example, US airline companies serve millions of passengers and create hundreds of billions of dollars of value each year. But in 2012, when the average airfare each way was $178, the airlines made only 37 cents per passenger trip. Compare them to Google, which creates less value but captures far more. Google brought in 50 billion dollars in 2012 versus 160 billion dollars for the airlines, but it kept 21% of those revenues as profits, more than 100 times the airline industry's profit margin that year. Google makes so much money that it's now worth three times more than every US airline combined. Damn. The airlines compete with each other, but Google stands alone. Economists use two simplified models to explain the difference: perfect competition and monopoly. Perfect combination is considered both the ideal and the default state in Economics 101. So called perfectly competitive markets achieve equilibrium when producer supply meets consumer demand. Every firm in a competitive market is undifferentiated and sells the same homogeneous products. Since no firm has any market power, they must all sell at whatever price the market determines. If there is money to be made, new firms will enter the market, increase supply, drive prices down, and thereby eliminate the profits that attracted them in the first place. If too many firms enter the market, they'll suffer losses. Some will fold and prices will rise back to sustainable levels. Under perfect competition, in the long run, no company makes an economic profit. Whereas a competitive firm must sell at the market price, a monopoly owns its market, so it can set its own prices. Since it has no competition, it produces as the quantity and the price combination that maximizes its profits. To an economist, every monopoly looks the same, whether it deviously eliminates rivals, secures a license from the state, or innovates its way to the top. In this book, we are not interested in illegal bullies or government favorites by monopoly. We mean the kind of company that's so good at what it does that no other firm can offer a close substitute. Google is a good example of a company that went from zero to one. It hasn't competed in search since the early 2000s when it definitively distanced itself from Microsoft and Yahoo. Americans mythologize competition and credit it with saving us from socialist breadlines. Actually, capitalism and corporate competition are opposites. Capitalism is premised on the accumulation of capital, but under perfect competition, all profits get competed away. The lesson for entrepreneurs is clear. If you want to create and capture lasting value, don't build an undifferentiated commodity business. You have to also capture the value. एग्जाम्पल है गूगल वर्सेस एयरलाइंस. Perfect competition. No company makes economic profit in long run. All profits get cheated away because in perfect competition, if the competition is low, it rises, and other people come in with cheaper price, so they also have to reduce the prices. So, and when it is already too cheap, and they're already making a loss. Opposite है monopoly, control the market, capitalism. If you want to create and capture lasting value, don't build differentiated commodity business. Because in an undifferentiated commodity business, there will always be perfect combination, competition. Okay, makes sense. Lies people tell. How much of the world is actually monopolistic? How much is truly competitive? It's hard to say because our common conversation about these matters is so confused. To the outsider observer, all business can seem reasonably alike. So it's easy to perceive only small differences between them. But the reality is much more binary than that. There's an enormous difference between perfect competition and monopoly. Most businesses are much closer to the one extreme than we commonly realize. Describing market condition. The confusion comes from a universal bias for describing market conditions in self-serving ways. Both monopolists and competitors are incentivized to bend the truth. Monopoly lies. Monopolists lie to protect themselves. They know that bragging about their great monopoly invites being audited, scrutinized, and attacked. Since they very much want their monopoly profits to continue unmolested, they tend to do whatever they can to conceal their monopoly, usually by exaggerating the power of their non existent competition. Think about how Google talks about its business. It certainly doesn't claim to be a monopoly, but is it one? Well, it depends. A monopoly in what? Let's say that Google is primarily a search engine. As of May 2014, it owns about 68% of the search market. Its closest competitors, Microsoft and Yahoo. If that doesn't seem dominant enough, consider the fact that the word Google is now an official entry in the Oxford English Dictionary as a verb Don't hold your breath waiting for that to happen to Bing. But suppose we say that Google is primarily an advertising company that changes things. The US search engine advertising market is $17 billion annually. Online advertising is $37 billion annually. The entire US advertising market is $150 billion and global advertising is 495. So even if Google completely monopolized US search engine advertising, it would own just 3.4% of the global advertising market. From this angle, Google looks like a small player in a competitive world. What if we frame Google as a multifaceted technology company instead? This seems reasonable enough. In addition to its search engine, Google makes dozens of other software products, not to mention robotic cars, Android phones, and wearable computers. But 95% of Google's revenue comes from such advertising. It's are the products generated just ठीक है, and its consumer tech products are a fraction of that. Since consumer tech is a 965 $1 billion market globally, Google owns little frank little monopoly. Framing itself as just another tech company allows Google to escape all sorts of unwanted attention. Claim monopoly lies is basically to claim to not be monopolies, so they don't get audited and they continue the image of competitiveness while being a monopoly. Google does it in a very smart manner by seeing its business as whole, not just search engine. Google has 64% of the search engine market, but as a software company, it only has like less than a percent of the market of total software products. So it's not a monopoly. Comparative lies. Non monopolists tell the opposite lie. We are in a league of our own. competitive lies are we are in a league of our own. Entrepreneurs are always biased to understate the scale of competition, but that is the biggest mistake a startup can make. The fatal temptation is to describe your market extremely narrowly so that you dominate it by definition. Suppose you want to start a restaurant that serves British food in Palo Alto. No one else is doing it. You might reason we own the entire market, but that's only true if the relevant market is the market for British food specifically. What if the actual market is the Palo Alto restaurant market in general? And what if all the restaurants in nearby towns are part of the relevant market as well? These are hard questions, but the bigger problem is that you have an incentive not to ask them at all. When you hear that most new restaurants fail within 1 or 2 years, your instinct will be to come up with a story about how yours is different. You will spend time trying to convince people that you are exceptional instead of seriously considering whether that's true. It would be better to pause and consider whether there are people in Palo Alto who would rather eat British food above all else. It's very possible they don't exist. In 2001, my co-workers at PayPal and I would often get lunch at Castro Street in Mountain View. We had our pick of restaurants, starting with obvious categories like Indian, sushi, and burgers. There were more options once we settled on a type, North Indian or South Indian, cheaper or fancier, and so on. In contrast to the competitive local restaurant market, PayPal was at that time the only email-based payments company in the world. We employed fewer people than the restaurants on Castro Street did, but our business was much more valuable than all of those restaurants combined. Starting a new South Indian restaurant is a really hard way to make money if you lose sight of competitive reality and focus on trivial differentiating factors. Maybe you think your naan is superior because of your great grandmother's recipe. Your business is unlikely to survive. Creative industries work this way too. No screenwriter wants to admit that her new movie script simply rehashes what has already been done before. Rather, the pitches the film will combine various exciting elements in entirely new ways. It could even be true. Is to have uh, suppose their idea is to have Jay Z star in a cross between Hackers and Jaws. Rapstar joins elite group of hackers to catch the shark that killed his friend. That has definitively never been done before. But like the lack of British restaurants in Palo Alto, maybe that's a good thing. Non-monopolists exaggerate their distinction by defining the market as the intersection of various smaller markets. British food, restaurant, Palo Alto, Rapstar, Hackers, Sharks. Monopolists, by contrast, disguise their monopoly by framing their market as the union of several large markets. Hmm. This is done by narrowing the scope of market. Ruthless people. The problem with the competitive business goes beyond lack of profits. But they can do outsized profits come at the expense of the rest of the society? Profits come out of customers' wallets, and monopolies deserve their bad reputation, but only in a world where nothing changes. In a static world, a monopolist is just a rent collector. If you corner the market for something, you can jack up the price. Others will have no choice but to buy from you. Think of the famous board game deeds I shuffled around from the player, but the board never changes. There's no way to win by inventing a better kind of real estate development. The relative values of the properties are fixed for all time. So all you can do is try and buy them up. But the world we live in is dynamic. It's possible to invent new and better things. Creative monopolies give customers more choices by adding entirely new categories or abundance to the world. Creative monopolies aren't just good for the rest of the society, they are powerful engines for making it better. Even the government knows this, that's why one of its department works hard to create monopolies, hunts them down. It's possible to question whether anyone should really be awarded a legally enforceable monopoly simply for having been the first to think of something like a mobile software design. But it's clear that something like Apple's monopoly profits from designing, producing, and marketing the iPhone, were the reward for creating greater abundance, not artificial scarcity. Customers were happy to finally have the choice of paying high prices to get a smartphone that actually works. The dynamism of new monopolies itself explains why old monopolies don't strangle innovation. With Apple's iOS at the forefront, the rise of mobile computing has dramatically reduced Microsoft's decade-long operating system dominance. Before that, IBM's hardware monopoly of the 60s and 70s was overtaken by Microsoft's software monopoly. AT&T had a monopoly on telephone service for most of the 20th century, but now anyone can get a cheap cell phone plan from any number of providers. If the tendency of monopoly businesses were to hold back progress, they would be dangerous and we'd be right to oppose them. But the history of progress is a history of better monopoly business replacing incumbents. Monopolies drive progress because the promise of years or even decades of monopoly profits provides a powerful incentive to innovate. Then monopolies can keep innovating because profits enable them to make the long-term plans and to finance the ambitious research projects that firms locked in competition can't dream of. So why are economists obsessed with competition as an ideal state? It's a relic of history. Economists copied their mathematics from the work of 19th century physicists. They see individuals and businesses as interchangeable atoms, not as unique creators. Their theories describe an equilibrium state of perfect competition because that's what's easy to model, not because it represents the best of business. But it's worth recalling that the long run equilibrium predicted by 19th century physics was a state in which all energy is evenly distributed and everything comes to rest, also known as the heat death of the universe. Whatever your views on thermodynamics, it's a powerful metaphor. In business, equilibrium means stasis, and stasis means death. If your industry is in a competitive equilibrium, the death of your business won't matter to the world. Ruthless people after this. I'm not able to understand anything. I'm very sleepy. We'll continue this tomorrow and finish it in one go. See you tomorrow.